Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Before I start looking and explaining what we're doing today, I just want to quickly mention about generally what the stock market is doing. So this week, okay, it looks like it's okayish. There's quite a few companies still down. The one thing I've noticed is a lot of companies have reported their earnings report and have had absolutely amazing earnings reports, but they're still down about 2%, 3%, 4%, 5%, and so on. So it's just a little bit strange because you expect when companies report, like for example, Pfizer reported a good earnings report, but their forecast is actually quite good. I think it was the revenue that was down a little bit, but the growth on the next couple of years, the guidelines was actually quite good. But it's down about 5%. In a way, I'm happy with that because I have a price target, I think below 50. If it goes below 50, I'm buying more, almost there now. So it's good for us as a long-term investors. Qualcomm's down, all the other companies that I own in my portfolio, according to Adobe and so on, and MasterCard, Visa, they're all down. Even Procter & Gamble is down about 4% this week. So it's fine. I actually would like Procter & Gamble to come down a little bit more because it's actually overvalued in my opinion right now. So yeah, so there's a lot going on in the market, and when you look at the full and you look at the includes the Nasdaq, it's a lot worse because they are down. They have been hit hard. Companies like, for example, Shopify and Uber's and all that companies, like the high tech, high flying companies. So what I want to do today is, in today's video, is carry on what we've been talking about, which is the Dow Jones industrial sector. And the reason we want to do that is because these high-flying companies are amazing, but you need to have a balanced portfolio. You need to bring down your portfolio, overall portfolio beta down at least to 1%, okay, below 1%. Because if not, you're going to run into all sorts of things because you're going to have a very, very volatile portfolio, and that's what I'm trying to do now. Identify the companies that are they're basically either overvalued and sell it, and buy companies that are a little bit more basically undervalued at the moment and have a lower beta, if you like, because I want to sleep well at night. I'm not really here just to basically get more gray hairs than I have already. Okay, so that's basically my plan. So what we're going to do is we're going to look at the companies that are in this Dow Jones industrial sector, and the companies that are in this sector, if you look at the indices, for example, right, all of these companies have one thing in common, and they are very established companies. They have a lot of free cash flow, and they are very well-known companies. Okay, all of these companies. So we've already done a video for 3M, Chevron, Intel, Johnson & Johnson, and Nike. Today's video, first company we're going to look at is Procter & Gamble. They are obviously, basically, they have a lot of different products, including beauty, grooming, healthcare, and so on. They currently trade in $157 per share, and then their PE is slightly, basically higher than the sector. So that's why one of the reasons I would like this to go down a little bit. And earnings per share of $5.66. And then you've got market cap over $378 billion, annual dividends of over 2%, 5-year growth rate of only 4%. I would have liked 5 or more, but that's absolutely fine. Dividend growth streak of 65 years in a row. Payout ratio of 60, which is good. Dividend safety, 99% according to Simply Safe Dividend. And that means basically the company will be paying their dividends in the next few years, because they've got so much free cash flow, so almost $15 billion in the bank. This is money they can use to buy back shares, to purchase new companies, to pay you some dividend, to pay off debt, all of these things, okay, they can do that. And this is what makes a great company. When a company has a free cash flow, they are in a very good position. Even inflation hits and this and that, they can still do well in this kind of industries. In this kind of market, sorry. And then you've got beta, just way below 1. Current ratio. So the current ratio helps us to actually find out whether the company is in debt, or anything below, basically above 1 is perfect. It looks like they have a little bit of debt, okay, at the moment, but because they have got a lot of free cash flow, I'm not too worried about it. I would have liked this to be above 1, so they have a bit of a debt carrying at the moment, so we'll see what happens. Profit margins, okay, really good. You're looking about 10 to 15% normally, about 18.5%. That's perfect. Return on equity about 31%, future growth about 5% or 4.5%. Again, these are the companies that are going to grow very, very slow. Okay, they're not high flyers, so that's normal. They are undervalued according to simply Wall Street. The price target is 214 and is a moderate buy at the moment. Okay, according to Morningstar, they are overvalued. Okay, they are 28, basically they're trading about 28% premium, and then the price target should be 123, and if you look at it right now, it's 157. So it has to come down quite a bit to actually, and when you look at the beta and you look at the sector PE, you can see it's basically overvalued. And then according to TipRank, it's basically they say it is undervalued at the moment, and it has almost 10% upside if you buy it, and the price target is $172 per share. So yeah, a little bit mixed, but I am with Morningstar. I'm not adding to it yet. If it comes down maybe another 5-10%, then I'll probably start adding to it and average up, because I am up quite a bit at the moment, so I'll probably do that. The next company we're going to look at is Merck, one of my favorite companies, is in my portfolio, currently trading $176 per share. It came down quite a bit in the last couple of days, which is nice for me because I can add to it eventually after it had quite a bit of a run. It went all the way to 80 something and came back down again. PE 15, way basically cheaper than the sector. EPS almost to $5, market cap almost $200 billion. It's got 3.5% of dividend yield, 5-year growth rate of 6%, dividend growth streak of 30%, and payout ratio of 44%. Now, dividends are absolutely safe. They have 8%, basically $8 billion in the bank. The beta is very, very low, and then current ratio above 1, which is very good. So that means next 12 months, they will be able to pay off their debt. If they have any debt, they can easily pay off that. Profit margin, so that's the short-term debt, by the way. Profit margin of 13.6, which is really good. Return on equity, 26%. Future growth, about 11%. This is solid. Okay, this is profitability. This tells us the company is doing really well with your money. They actually generating massive profit. Okay, and the future looks really good. And top of that, it's definitely undervalued at the moment. So according to simply Wall Street, is 68% undervalued. Their price target is ridiculous, $230, almost $240 per share. And look at it right now, it's only $76 per share. So there's massive upside on that. It's a buy definitely. And according to Morningstar, is 19% discounted, $94 per share. Again, it's massive upside, so 19% is good. 17% according to TipRank, and they are saying it should be about $90 per share. So everyone agrees this is definitely undervalued. It's a quality company. I own a lot of shares of this company. I would like this price to come back maybe about below 73-ish. I think my average is 76 or 77 or something like that. So it would be nice if it goes below a little bit so I can add more to it. Right, third company we're looking at is Home Depot. Again, I own this basically a couple of shares of this company. Currently trading $335 per share. PE of 23 according to the sector is actually cheaper than the sector. EPS almost $15 per $15, and then you've got market cap of $371 billion. Annual dividend of 1.85, and basically when it comes to 5-year growth rate, look at that, 20% growth, and they have been basically paying or increasing their dividend in the last 33 years. Okay, 33 years. And then payout ratio of 44%, dividend safety 87%. They have $12 billion in the bank. Beta is quite low. Current ratio is above 1. Profit margin, and the profit margin is actually quite nice, about over 10%, which is fine. And return on equity of 1,240%. Okay, when you look at the when you look at the consumer discretionaries, they normally have a high return on equity for some reason. Future growth about 4%, 5%, which is fine. Right now it's overvalued according to simply Wall Street. $308 per share, that's what it should be. It's right now $355 per share. They are saying it's still a buy, but I think it's a hold for me. I wouldn't add to it yet. According to Morningstar, it's 46% premium right now. That's really expensive. They saying it should be $244, and right now, as you can see, it needs to come down at least $100 below what it is right now. And the next tip rank, 20% and upside, and they saying the price should be 428. Now, tip ranks is they're quite bullish on basically generally. Morningstar, I like them. They're very conservative. That's what I want to be. That's where I want to be majority. So I follow a lot Morningstar. That's why I have subscriptions for them. And then Simply Wall Street is kind of right in between the two of them. So that's basically it. Again, great company, home improvement retailer, and probably I'm not in the US, but apparently it's one of the basically Lowe's and them are the only two major companies out there that are doing also the home improvement sector kind of thing. Right, the next company, Coca-Cola, you know this company very well. At the moment, according to my estimation, I think it's a little bit overvalued, but let's have a look at it. Current price share of $61 per share, PE 30, that's expensive. 28 is the 25 or 26 is the sector, and EPS $2, market cap of $256 billion, annual dividend closer to 3%, 5-year growth rate of 4%. They have been paying their dividend 58 years. This makes them dividend king. Okay, 50 years or more is a dividend king. I think Procter & Gamble is also dividend king as well. Payout ratio 71%. Okay, again, it's safe. Dividend safety about 80%, which is absolutely fine. They have $12 billion in the bank to buy back shares on all of the other debt and all that stuff. They can pay you dividend as well. Beta is very, very low. Current ratio above 1, which is very good. Profit margin 23%. Return on equity almost 40%. Future growth 7%. Can you imagine? Coca-Cola has been around for hundreds of years, and they're still growing 7%, 6%, or even more sometimes. And this is solid company, I'll be honest with you, right? I really do like the business model, but it's really overvalued. And that's why I sold what I had before, and I'm waiting for it to drop back. But guess what? It reported their earnings yesterday, and then what happened? Let me show you. Let me go back to here. And then I think it went straight, yeah, there we go. So it went up on about 1% yesterday, and after earnings report, but they had a really good earnings report, which is quite nice to see. So yeah, according to in terms of, is a little bit undervalued at the moment according to Simply Wall Street. The price target is about 61%, exactly where it is right now. I would say it's a hold for me right now. If you have it already, I would say my buy should probably be about 55 or maybe below that, just to have a bit of a margin of safety. But fair value, according to Morningstar, they're saying that the price should be about 59, but I think for me it will be 55-ish. And then you've got tip ranks, which I'm saying about $65 per share. It's got about 7% upside at the moment, according to them. Right, the final company we're going to look at is Microsoft. Microsoft is one of the biggest companies out there in terms of technology side of things. Currently trading $302 per share, PE of 32, and it looks like it's basically trading the same as the sector. EPS of $9.40 and market cap of $2.2 trillion. Annual dividend very small, okay, just below 1%. 5-year growth rate of 9%. 15 years of paying dividend, payout or increasing their dividend, payout ratio of 26%. Okay, very, very low. They've got so much cash as well. You will see that in a second. Current ratio above 2, which is absolutely brilliant. They're not going to run out of money anytime soon. Dividend safety of 99%. Free cash flow of almost $61 billion. This is money they can use to buy Activision Blizzard, this and that. They've got so much cash, trust me. Beta just below 1, which is really good, and especially for a tech company to be below 1, that's really nice. Profit margin of 38%, and then you've got return on equity of almost 50%, which is amazing. And then for future growth expected next 3 years, whatever, it will be about 10% more. Undervalued at the moment, according to Simply Wall Street, about almost 37% undervalued. The price target should be $479 per share. Right now, it's only $300. According to Morningstar, it's 14% discount, $352 per share. That's where it should be. tip ranks is actually saying the same thing, so 375, and then it's got 24% upside, and it definitely, for me, it's absolutely a buy. Right, just remember, the reason we're looking at these companies is not just because of the dividends or anything like that. Obviously, dividends are amazing, a massive thing for me anyway. But at the same time, you want the companies that are very, very solid, low beta, have a great future ahead of them, that well known, have got cash in the bank, that give you return on your investment and so on. You can add a couple of speculative companies, is fine, but the way things are going right now is you are better off making sure your portfolio, basically about maybe 70%, you can have this type of companies, solid companies that have amazing cash flow and so on, and then maybe 10%, 15% of whatever speculative, and another maybe 10-15% of other companies or other sectors, or like basically REITs or something else other than this type of company. So you can have a little bit of a speculative companies, a little bit of a solid dividend paying companies, and then maybe a couple of growth companies, if you like. And I'm talking about the like the Salesforce of this world, okay? Because remember, Adobe's and Salesforce, they're still growing companies like the Nvidias and so on. But you also have the high flyers, think companies like Zoom or whatever, you basically, that are down almost to 20%, 30%, 40%, 50% this year. So yeah, you kind of need to manage your portfolio, but at the same time, you really need to make sure you have this sort of a companies to kind of help you. Now, overall, my portfolio so far, like I've shown you at the beginning, it's just the markets are very volatile at the moment, and I'm basically, every time I check, I see new companies that have actually gone in the red. I'm like, okay, that's good. And then when I look at the overall Morningstar and the overall portfolio, when I look at it, there's quite a lot of companies that are undervalued at the moment. So I made a list of the companies that I want to add to in the next few weeks. So inshallah, we'll see how it goes. But again, I'm not selling anything. I'm adding to the stocks that I've already got. I don't think I will be adding any new companies in the near future. But I just want to focus on the ones that I have that undervalued, like 3M. 3M is, at the moment, there's something going on with 3M, and they've got some sort of a legal thing going on with US veterans, whatever. So we'll see what comes out of that. But at the moment, I don't think I will be adding to it, but definitely will be adding to air products and chemicals and so on, see how it goes. But yeah, that's my portfolio. I've been transparent. As I've always said to you, a lot of the companies that I've talked about today, in fact, I own all of them apart from Coca-Cola. So yeah, if you would like to go through my portfolio and see what it is, I'll share the link I will pin it on the comment section, so you can have a look at that as well. Thank you very much for watching. Assalamu Alaikum. Take care.